Hey, good afternoon, everybody. Welcome. We're going to get started here. Sorry for the late notice, but we got a little behind schedule there. Hey, Alex. Hey, guys, ladies. I see Denise is with us. It's been a while, Denise. Welcome. Hope you're doing well. So today we're going to talk about volatility, and there's a lot of news revolving in the markets this year, not just this week with it's just too much going on. So much of this news is kind of ridiculous. But the judge thing,
Kavanaugh hearings,
it's so ridiculous. It's laughable that things have gotten to this point. But the news this year has really pushed the market around much more than it has in the past, with trade tariffs and wars and who's going to go to jail and what smoking gun's going to fall the following day. It's certainly entertaining, and the news media has had quite a great year from it, of course. Anyway, so we're primarily interested in how that affects price action and how we can take advantage of it. So we're going to look at some of the markets that have been affected. We'll talk a little bit about market internals and interest rates and so we love what we do. It's always interesting. Markets are always changing, and one of the reasons that we enjoy it. It is always a challenge. As much as we can laser in with sometimes pinpoint accuracy, at times the market pushes you back and says, hey, hold on a minute there. We're going to change things up a little bit and, deal with this for a while. And we enjoy it. It's part of what we do. And so I'm welcomed by Dan, of course, my partner. And we do this every week. And we have our back and forth conversations. They're always interesting. And everyone enjoys it. So if you have any questions while we're going along here, you're certainly welcome to ask. But hey, Dan, how's it going over there today?
Hey, excellent. And yeah, just to add a couple comments to that introduction, it made me think of the saying on Wall Street that particularly in bull markets, or in any kind of market actually, the markets are always climbing a wall of worry. And that's the saying in a bull market, but it's a discounting mechanism where it's supposed all the market participants, whatever they're looking at to make buy and sell decisions, the market is the place to put all those collective beliefs together to reflect the true collective beliefs of supply and demand. Right. So yes, they're always worried about something, but it's discounted. So the extra point I wanted to make was this particular week, there's differences in ongoing wall of worry as opposed to specific individual events that it's either in an announcement at a certain time, like today at 2 p.m., the FOMC announcement. And yes, we'll obviously take a look at the sectors and look at affected ETFs moves from their decisions. But then there's also the events tomorrow that, like the hearing, the Kavanaugh hearing with the sexual assault going on, trying to get him approved to the Supreme Court. So that can cause some volatility for hours.
Yeah, and then the rose and stuff. I'm thinking as you're saying that, and this event being as big as it is, I'm thinking possibly to close down, our green room tomorrow and order a big hero sandwich and some beers and turn on the TV.
Well, and just tell them to get some popcorn and enjoy the fireworks. But another point you mentioned earlier about, look, we have the master trader method. We know what we're doing. We know what to look for. We just look at it every single day and come up with our bias for, short and medium term. And our bias this week, today's Wednesday, but our bias Monday, Tuesday, Wednesday has been the same. Consolidation, choppiness, indecision, stand on the sidelines, only focus on what we call tier one trades or things that are on their page, like they don't care what the market's doing. This is in alignment and we're going to take a position in you. But we have no positions, you know, that we want to take in the broader markets right now because we're waiting, as you call it, for clarity, for an event to happen. And we can talk about those potential events when we look at charts.
Yeah. You know, everybody that comes to view our events, and we always try and share our experiences and the things that we've learned. And it's one of the things, and everybody's always heard it, you know, what makes this difficult is really what goes on between your ears. I mean, we can teach the patterns and such. And one of the things that I've constantly have to reinforce for myself, even today, is kind of what you're saying about what's on the chart and what's reflected. And it's like, you know, the chart says this, and we're influenced by all of these news events and things, and they do play on your mind. And I mean, I still to this day have to bring myself to, that's a buy setup, press the button.
And you know, you're making me think of trading news, and we can actually look at KBH, a home builder stock today. One of our members said, "Oh, blowout earnings on KBH," and I looked at it in the first 15 minutes, and the whole bullishness, you know, collapsed and it turned bearish. So, what does that bullish earnings news do to me to want to get the stock? The answer is absolutely nothing. There's no bullish setup. But as you know, we love bullish setups that are facing bearish news. So, you know, but that's a separate subject. But yeah, they have to be in alignment, of course.
Right. And, you know, that's a home builder, right? KBH?
Yeah.
Yeah. So with these interest rates going up at the rate that they are, and we reviewed the yield chart in the room this morning, that 30-year yields are ready to break out of a big bottom, and that's not going to be good for home builders. Historically, it's not.
Right, and I'll ask your opinion when we have a real chart in front of us. But with yields looking higher, I know we're getting a short-term bounce in bonds. So again, we'll wait for the charts. But I understand home builders going down, the ITB, but banks have been under pressure the last 3 days, surprisingly too.
It's an interesting market.
Right. So,
you know, the regional banks, which were looking good a month or so ago, and then they broke down, and then last week they popped up, and now they're looking like they're going to break down again. And it's just been some erratic price action that's gone on this year from time to time, and that erraticness is back right now.
Absolutely.
Yeah.
Well, we've kind of talked about the items on this page already, but you know, you can, first bullet, you can list any fear you want. That is the flavor of the day. But as I mentioned, some of these are event related. Today at 2 p.m., FOMC announcement on interest rates, and everybody's expecting a quarter point rise. The futures are expecting it, et cetera. So as always the case, we're going to be worried about the subsequent commentary that's going to follow, which is going to affect people's expectations about future moves. So we'll take a look at that. But, you know, pick your flavor of worry. Our approach is to focus on only thing that matters, which is price action, intermarket analysis, and looking at multiple time frames. And as we said, this week, they haven't been in alignment, so we have not been aggressive at all.
And, you know, that is a huge advantage, because if, look, we look at our trades, we reevaluate, and one of the biggest things is, boy, if I could have avoided that loss. And part of it is recognizing that in this moment in time, that particular stock or this particular market is trading in a way that it doesn't offer a lot of profitable trade setups. And recognizing that is tremendous, because you just stand aside or you put on smaller positions, and ones that work obviously will take care of themselves, and the ones that don't, you know, they're calculated losses always, but I'd rather sit on the sidelines with a clear mind than kind of feel like I've just kind of been running in place for a while and getting tired by just the turn in the market.
Yeah. Well, it's not only running in place, but it's if you're sitting in positions going against you, particularly if you did something stupid like not follow your trading plan, then that pain and distraction is just preventing you from looking for opportunity. So it's a very bad situation.
It steals your attention and focus because
Right.
you just kind of, I don't know. Enough said. We've all been there.
Right. So when people do that, whether it's, I don't care the reason for it. In fact, I had a subscriber call us after the market yesterday who's in two bad trades, the Amazon and SQ, call spreads that are going way against them. And he's like, I know, don't lecture me. I know I screwed up this and that. So anyway, after 25 minutes of discussions, I said, I'm not going to beat you up, but here's what I ended with. You have just paid tuition to the market. Learn from it. You know what you did wrong. You shouldn't have entered. You didn't trail like we did on Square, getting out at the low. You didn't take your stop, and just learn from it. And then that's what we call you're paying your tuition to the market. But if you don't learn from it and continue to do the same things, you're not going to last. You're going to blow your account up.
Yeah.
So again, we've covered some of these. I've had this slide before, but there's many ways to skin the cat and success in trading, in investing. And our approach is the master trader method. As I said, we're looking for a high probability setup timed with market internals. You enter and then proper position management per your trading plan. It's really that simple. It's simple by the books, meaning how we teach it, but then it's back to Greg's pattern. It's the problem between the ears, because we can give the identical trade, identical setup, identical plan before we enter something, and I guarantee you we'll have 5 different results from 5 different traders. It's because of what's between their ears.
Different methods, but what we do every day and teach and do it is try and strive on consistability, because like if we're applying what we do on a consistent basis, we should come to the same conclusions, meaning this is an uptrend, this is a buy, this is downtrend, this is sideways, this is chop. I'm standing aside. And I've said this in the room, multiple times in the past, that the majorities that want to trade in the market and the fewer that actually want to learn how to do it properly, the last thing they want to learn about is money management, which is, little insane. But
that's like taking flying lessons and saying, I don't care about the safety component.
Absolutely. And, if you're applying money management and the technical analysis and you're evening out, your risk by calculated losses in a plan, once you see the setup, it's almost just press the button, because we always try to get the best odds by evaluating the quality of the setup and the market environment. But in the end, we really don't know which ones are going to work the best. So put on the position and manage it accordingly.
Right. And when we did our scanning in the green trading room today, we have a number of very nice setups, but we purposely said we're not trading in front of the FOMC. In my experience, the FOMC, you get 3 vicious moves over a 75 to 90 minute kind of period, 75. And after that, you typically get the correct move into the close. So that's when we'll take a look at the stocks that we have here in our minder, but otherwise not doing much till then.
Yeah, I haven't been doing much the last few days, but guys, I pre-market uh, review. I just been saying that things are not set up here to
And that's
really
been
move
dead
one
on.
way or the direction, and they just haven't.
It's been dead on.
So, yeah.
Yeah, why don't you just give a few comments about this, and then we can start scanning.
Yeah. I mean, this is our day-to-day approach to the market about, and what we've been teaching for years about it, proper thinking and looking at the chart. So, and one of the concepts that I came up with, well, 15, 20 years ago, out of, it's like, how do I manage this trade? And I was like, hey, every one of these candles produces thoughts. How do I know what to think? Because, look, when you don't know what you're doing, I kind of referred to the markets, as, especially the way I approach them. Back when I first started out, I was swinging for the fences. So it was kind of like what I kind of referred to as a white knuckle ride. It's like, hey, I see the money. I don't have a risk management. I'm swinging for the fence and kind of like with a blindfold on. And, so it was like a, white knuckle ride. If you don't know, it's like, get in your car, do 120 miles an hour, and, you'll see your knuckles turn white as you're holding onto the steering wheel because you're scared to death. But the interesting part is you're scared to death, but meanwhile, you're pressing down on the accelerator in the market. It's insane. And that's what makes the market to market. But
And
anyway,
well, and yeah, maybe you're interrupting you, and you're going to finish it, but please tell us how you got off that white knuckle ride and learned from your mistakes, like I was mentioning with this other trader.
I just answered the question. What was that again, Dan, please?
You might be ready to say it right now, but what made you learn objectively to get off the white knuckle ride and stop doing stupid stuff and doing proper objective trading?
Oh, this will be interesting. I lost a ton of money. And
so you just hit your pain point, or what was, that's what I'm asking. What made you change?
I'll tell you. And you remember these things because of the emotional attachment to them. And, I was staring at the screen. I was down 30,000 in the moment, relatively quickly. And, the saying of feeling the hair on the back of your neck stand up was there. And I came to the realization you're playing with something here that you didn't bargain for. And you know what? While that loss wasn't going to change my life, it was painful. And I came and I said, you know what? I'm going to learn how to do this the right way. And for most, they don't come to that realization until it's too late. Maybe for me, the pain rose exponentially versus someone who's, let's call it a slow bleed to where they just run out of money. In any event, someone always has to come to the point where they decide to do something the right way. It's not a game.
And my point was, I got so tired of listening to so-called broker experts who are just salesmen. And I'm like, no, I want to learn to make my own decisions. And that's when I was fortunate enough to, to meet you and work together 20 years ago in New York.
Right. So again, as the slide says, when we look at those charts, we're really looking at what everybody's thinking. So when I look at a sloppy sideways consolidation, it tells me that the majorities are uncertain and they don't know the direction, but everybody's placing their trades, but the battle goes on to where nobody's winning. And that's kind of, in a sense, from a short-term point of view, what the market's doing right now. Whereas when there's certainty, things move rapidly in one direction, and we see a continuous flow of bars moving in one direction. So when we look at charts, it's not about a name. Names help us communicate. It's kind of, a short code, so to speak, to where it, you know, I said, hey, look at that head and shoulders top, and you're familiar with the pattern.
Right.
You already know what you're going to look at. Where, you know, so when we talk about a downside shakeout, one of the patterns we look at, you know, anyone who's learned it, they know what to look at. So we can use that short code to say, look at Square or, you know, an airline stock. It's got a downside shakeout or so on. So they communicate to us what others are thinking and what they're doing and what their expectations are. And one of the biggest things that I learned was failed patterns, who striving not to lose money and looking at the trades where I lost money. I said, how do I take advantage of that? You know, we all said, hey, if I could have flipped on that trade, I'd have made a ton of money, but how are you going to do it without a plan? So, you know, here opens up this guy with his hair standing up with that pattern on the bottom of the slide there, where it looked great, and then it reversed down in a very nasty way. Now, if I can find setups where that has happened in alignment with the trend and resistance or support, I really got something there. And that's the essence of our method and what we teach, is how to put that all together. It's powerful.
Right. Well, so you said you've been busy lately, and I know it's been on this new course. So why don't you be the first to describe it here?
Yeah, you know what, this is evolved from the Master Trader Technical Strategies course, which is, you know, a huge course. And that was, you know, at the time when I created that, was here's a course that can do anything, meaning whatever you're going to trade, it'll teach you how to do it. Whereas the swing trading course takes that, you know, scales it down a bit, but it really condenses it into the focus of swing trading. So one of the things that you do when you create a course is, first you make it, meaning slides, what you're going to teach. Then you record it. Then you edit it. And the editing process takes easily double what it took to record it. Anyway, so going through the editing process here, and you might find this a little funny, but Dan, you've been through it yourself, is, you know, editing that and listening to myself talk, and I'm like, damn, this stuff is really good. You know, you did an excellent job on this, and, you know, it's great. And I've been, you know, using this stuff and teaching it and doing it for close to 30 years now. I mean, 30 years ago, I knew next to nothing, but, you know, this is an awesome course, you know, for swing trading. And, you know, swing trading is great for so many because it's a few days to a couple of weeks. And, you know, look, we're in the chat room where we do option trades and we do some day trades. But look, for this is great for, hey, I got this position on and it's doing what it's doing, and, you know, I'm managing it accordingly. And this teaches you how to do all that with market internals and multiple time frames and relative strength and weakness and everything you need to do it. Well, so I plan on getting this out on the website by the end of the week and the weekend, and there it'll be available.
And Greg, I'm just reading your title there. Swing trading can provide big profits days to weeks. Totally agree with that, of course. But it reminds me of a CNBC commentator I heard last week talking about something when the announcer asked him, so what are you investing? You know, what in the next, you know, whatever his question was the short term, what do you see? And he says, I don't enter anything unless I have a 10-year perspective that I can stay in it, and I don't mind a 20% you know, drawdown. And I was just shaking my head. I'm like, what planet are you on? I said, the swing trading, even our new ETF investor letter is meant for a longer holding period. So this pullback we're getting in the market this week is just a blip on our massive gains. But I was just shocked by that comment, and it goes back to our first slide about the collective beliefs of different market participants. So we disagree with that vehemently, and he disagrees with ours. But ours is successful, so we live happily ever after.
Okay. Well, everyone has their own method, and if he can look out what's going to happen over the next 10 years with any accuracy, I'm willing to take his course.
All right.
Anyway.
And yeah, so just before we start scanning right now, then, people love this advanced, mastering advanced credit spreads course that's in the middle here, this gold. It's selling credit spreads. Well, let me back up. Swing trading that Greg just described is when we have multiple timeframes in alignment and we're trying to ride a chunk of a bigger move. And then we get off it. We wait till we get it's like riding a bus or a subway. We're just waiting for our entry and exit, manage in between. That's called a directional trade. We also have these income trades, which is just finding a pattern saying, well, it's not going here. It's not going down. It's not going up. It's range bound. And we sell credit spreads around those patterns. And we keep the money when we're correct in our bias of the stock not going there.
Yeah.
And then the platinum room here, you get the mastering course and 3 months of the green trading room, which we're very active in. We have a great group there. We have to start at 9 a.m. with the pre-market game plan that Greg does. Then we come up with our watch list. We're watching them. We're adjusting, coming up with new trades, new scanning, and then 3 months of the weekly option trader. So go to mastertrader.com/spread trader. And you'll love it.
Yeah. It's an interesting concept because, before we started recently working very closely together, Dan, credit spreads weren't something that I paid really any attention to. I was a directional trader, whether it was intraday or swing trading. And as we started getting into that and looking at the chart, and I look at that and I was like, damn, this is a mess. He goes, yeah, that's perfect.
Right.
Yeah. So, what works well for something else is totally opposite, but that's just, different trading strategy. But yeah. So.
All right.
The questions about the courses, Dan, but I know everybody probably wants to get to the charts and,
yeah, me too.
Yeah.
Because we love scanning for opportunity.
All right, so let's bring them up, Dan. I'll switch screens if you want to answer some of that about the spread course.
Yeah. So, Gene, yeah, definitely we do. We trade directional trades with options using in-the-money options, definitely. And then, so we just generally start with a 85 delta since we have a directional bias. And then our strategy is to either take our profit if we're just swing trading or to leg into a credit spread to increase the probability of profit, similar to legging into a covered call, but we're legging into a debit spread. So yeah, we definitely do those.
All right, so I started with this screen, Dan, with the market internals, and we could look at the direction of bonds as well, since it's Fed day. And you might be surprised how long short-term interest rates have already been going up, and now everybody's focused on that. It's like, what were you doing over the last 2 years? But anyway, so we follow market internals as to breadth and sentiment, and we look for when they're in agreement with each other. And right now, they're not. So you can see, let me just get my little drawing thing out here. This one is breadth right here. It's called a McClellan oscillator. I certainly didn't create it. It's been around for a long time. It's relatively simple, just looks at advancing stocks minus declining stocks, plots two moving averages of them, and looks at the difference between the two. And that's what the line plots right there. So when it gets to 100 to like 200, you say it's at a bearish extreme, and down below here, minus 100 to minus 200. Really severe corrections get to minus 300. It says, hey, this has gone too far. But that doesn't mean things are going to turn around immediately. Internals lag a little bit, which is good. If I needed it to tell me on the spot where I had to take action, that would be a little difficult. And then we look at sentiment, which is this one here. What do traders think about the market? And this is focused on options traders who are typically undercapitalized and more emotional and more hedging. So where they're climbing that wall of worry, and we look for when they start to use options, which are leveraged a little bit too much. And when they get to an extreme, the market historically turns around. And what I'm looking for is either a bullish extreme for both, where this becomes oversold. And over here, option traders are buying a lot of puts, bearish bets. And that gives me a historical piece of information that says the market's at a bottom. It should turn, or vice versa. And as you can see right now, it's pretty neutral. So it's not telling me much of anything. However, today, these option traders are a little heavy on the call side, which can have an effect intraday. But, you know, as far as our swing trading perspective, really doesn't mean too much of anything anyway. So we don't get any good information there as far as the market goes. And then I look at the S&Ps, which are holding here today within this range. We've got a support point and a resistance point, but so far we got a green day. The Russell here has been holding and starting to make another bottoming tail bar right there, but in this range, so sloppy. And this is what we've been talking about in the room, that the markets are in a little bit of a corrective mode here, and they don't know what to do. So we're standing aside. However, the Qs, the NASDAQ 100, is coming up to the top of its range, and it's had a good day a few days ago, but it had to gap down pretty big down into this support for buyers to show up. And that's kind of been the MO of this market, where it gets concerned as if some disaster is brewing and it sells off, and then the buyers show up again like, oh, we got nothing to worry about. Let's take it back up to the highs. And you know, that's been what this year is about. And overall, you know, it has been trending up. And look at that from a little bit of a longer.
So, Greg, I'm just listening to you talk. And since we, in our slide earlier, we said charts don't lie, discounting, we got all these pending news events. So what you just said, coupled with volatility, your bottom middle chart, being low and on support. And I'm just looking at VXX on my screen here, which is the volatility ETF, which is based upon VIX futures, because you can't trade the VIX. That's just a squiggly line measuring the implied volatility of S&P 500 30-day out volatilities. You can't trade that. So the point I'm getting at is, yeah, we have FOMC today, and we'll look at those sectors when you're done with this page. But this big pending news tomorrow with the Kavanaugh hearings and Rosenstein and this and that, they're telling us, yes, they're sloppy and indecision by looking at the index ETFs, but these market internals and volatility, people are not scared. They're not pricing in a lot of fear for these pending events. So maybe if things turn negative, volatility might spike tomorrow. But the way Master Trader trades volatility, though, is we also time it with the spiders. So we would want to see a bearish, spider. And what would that look like? Well, taking out the week's low, possibly. Any event.
And, just think about, well, I can clear up these drawings right there, but no, I mean, look, we've got this green day so far today in the S&P. And so when you're saying if news came out tomorrow and we really, well, it could come out, whatever, and get a red day below those three little bars ranges there. But as we look at patterns, what if it was to gap down below those three lows?
Right. And
I think that would almost immediately result in a move down to that level.
Right, which is still not that big. And that's why when we teach that when you buy volatility, you have to be very right on timing. It's so much easier to sell volatility because of the headwinds inherent in those ETFs. But, you know, Greg, when we did go long the spiders and diamonds at Master Trader for our subscribers, I kept getting all these emails from other people, other services, that they're buying the, you know, volatility ETFs. Take a look at VXX. Even with this pullback in the broader markets, the VXX is in a nasty downtrend. The buying volatility is very difficult, and there's no setup to buy it right now unless you're just a gambler hoping for some bad news to you know, cause this to spike and then you sell it. But that's a lottery ticket. The charts are not in alignment for that.
I mean, I think anybody that can, you know, decide if something's going up or down would say that's going down and no reason to buy it.
Well, there's many services out there advocating doing the opposite of buying volatility options, futures, and ETFs.
Looks like a no-brainer losing trade to me.
Right.
Anyway, so let's see. I don't know if I have this link down here, but one of the things I wanted to look at was, you know, because of the focus of the Fed here and interest rates, those are 3-month interest rates, and they've been going up for a couple of years. So this has been anticipated that interest rates are going to go up, and you can see they were down near zero. And so, you know, this is not 21. I think it's more like 2%. But anyway, it's just been going up and up and up and up. So it's going to be no surprise if they're raising interest rates. But look, more of something to keep a focus on is long-term interest rates. So here is the 30-year. And if we look at this on a weekly time frame, you'll see the bottom that is forming or has formed, and that, you know, also here's, you know, this head and shoulders type of a bottom there, where it looks like they're going to break out and, you know, a move up to, you know, maybe up into that level. And so Gene's saying it looks like a good trade. Sure. You can buy TBT or short TLT, which are ETFs. Now, so with the idea of the Fed raising interest rates, it really becomes a concern when you see this chart going down and the other one going up. And that's not happening now. So there was talk earlier in the year about a narrowing yield curve, and that's what this means. You know, is that if long-term here is going down and short-term is going up, that curve is narrowing, and eventually when they invert, it's a problem because the market then goes into a bear market historically. But now, you know, just the opposite's happening. This is going to go up. So while they're both going up together, that's good for the market. And it's like the market's going up 9 years already. Can it go up more? Well, the trend is up, so don't fight it. We'll see.
Hey, Greg, just to give our viewers a gift, since I mentioned our ETF trader investor letter, and this, you're talking about a long-term, you know, trade here. What would be our recommendation to our ETF investor subscribers, either to buy the ETF for interest rates or short the ETF for bonds?
Well, looking at this chart, would be to buy TBT. which is right there.
Right, but so I guess I'm asking you the technical pattern. Do you want it to break out and pull back to minor support, or just buy it, stop under the base, and manage in between?
Well, when we talk breakouts, that's a different subject, but we don't buy breakouts that go from the bottom of the base to the top of the base.
Right, and TLT is extended now, right?
So, you know, we don't buy this, right? We buy this. So it consolidates a bit and then breaks out, or this pulls back in and then we get on board in that way. Yes, Jim. TBT is yields. So yields, long-term yields, intermediate-term yields go up because there's a demand for money. I mean, people are going to the bank and saying, hey, I need some money. I want to buy a new car. I want to buy some furniture. I want to buy 20 computers for my office or office furniture. I want a new business. This is what happens when you have an expanding economy. And you have the Fed raising short-term interest rates to kind of put the brakes on a little bit. And when things are really bad, as they were some years ago, you see that the Fed keeps lowering interest rates and pumping money into the system. What was happening was, hey, they're pumping all this money into the system. And, you know, prior to recent times, they're saying, hey, I don't want your money. You know, I don't have any confidence that this economy is going to get better. Well, meanwhile, the stock market went up, but the economy wasn't expanding. So now we see that long-term interest rates are beginning to go up. And that's not a concern until, let's say, they go up too much and things get overheated. And then, of course, the cycle starts to change to where interest rates have gone up high enough to where, why should I put my money in the stock market when I can get this great yield with relative safety? And so it's the cycle that repeats over and over and over again, but it's been a long time coming. So it's going to get interesting, you know, and as you see if these yields, they're going to break out of here. And then, of course, the intermarket analysis part, we'll start looking at, you know, agriculturals and metals and stuff to see that commodity prices are rising. And that's the whole cycle of intermarket analysis that'll eventually play out as it has in years past.
Well, good. I look forward to putting some of those in our ETF litter, commodities.
Yeah, and you know, I thought they were starting to break out some months ago, and then the breakout actually failed. So, you know, maybe they're getting ready again. It's been coming. So that intermarket analysis is part of what we do, and of course, want to take advantage of that with our ETFs. So maybe I don't want to buy corn or soybeans or such, you know, but I can buy a ETF that's based on commodity prices.
Right.
Yeah.
Do you want to look at gold and ITB and XLF since we're talking about interest rate related ETFs?
Well, Alex and Gene are on a theme of inflation. And so the Fed raises interest rates to curb inflation, right? To keep inflation in check. So what will happen, let's say these interest rates break out and they continue to go higher. The Fed will keep raising interest rates. And at some point, it will become an issue if they start to catch up, and we'll watch to see long-term interest rates then come down. But, you know, prior to like recent times, well, it's interesting now when they were pumping so much money into the system and lowering interest rates, and you kept hearing worries about inflation. But if you looked at long-term interest rates and they were declining as they were, it's like, what inflation? There's no signal of any inflation here. So you have to know how this works and not turn on the TV and get your information there. And it's simple stuff, like everything is once you know. And that is what comes with education, of course. But eventually, gold has been going down, of course, because there is no inflation. But eventually, maybe gold will start to come back when long-term interest rates go up high enough and commodities go up, and then that's where the sign of inflation is. Not happening now.
And since you mentioned the yield curve, even though it's less of a problem now than a few weeks, months ago, I just like adding the following fact that you always tell people, which is even though we have an inversion, the actual recession can come 6 to 14 months later. So yes, it has a very significant effect, but it doesn't happen on a dime.
Absolutely not. I mean, you go back and look at that in 2000 and 2008, it took a long time before it actually had the really big negative effect. But, that's to our advantage, to where we can know what's coming with confidence. Yeah. All right. So let's look at some sectors. I don't think there's anything here.
Yeah, the interest sensitive ones first, I guess. So gold, ITB, XLF.
Just looking at.
Because there's been, similar to my comment about, people buying volatility at the wrong time. There's been a lot of newsletter people pounding the table on gold for the last couple of months, not days. And so we watch it as we do with other sectors, but there is zero reason to be long this, in our opinion. Looking at daily, weekly, monthly.
Yeah, and I've been saying that as we review in the room day to day, but in retrospect, 2020, I'm kind of thinking, why didn't we short it? Which we did. Right. But there were better opportunities on the long side, so it really wasn't a thought. But just looking at the pattern, clearly, based on what we do, I mean, this was a relatively easily short right there as it broke down.
On that gap down day, we were selling out of the money credit spreads at least. So
yeah,
that's better than nothing. But directional.
We have this discussion a lot. I mean, credit spreads are fantastic, income producing strategy, but the big money is in the trend trade.
Absolutely. That's why we do both.
Yeah, do both. Yeah. So, looking at gold and the ETF here, it's got room to move lower. And, it just has been, even after getting a bit climactic here, the bounce is anemic at best. And notice, so this is part of what we teach and I've gone into in the class, of course, is when we look at these moving averages as visual aids, and you see the distance between it here, where you could say, hey, that's telling me that things are getting extended. And now look at how they're getting tight again right there. So this consolidation where they were, prior to this extension has not been able to produce a move to the upside, which suggests it's probably going to move to the downside. But, sideways price action is such that you stand aside from it and wait for the confirmation. And then, we go with the trend. And while we can trade against the trend, when it reaches a climactic point, this has produced hardly anything, which is a strong message that there isn't any great interest here in gold.
Right. And
so let's
ITB.
We could look at oil, which has been doing very well, which is in alignment with, this is a core, that's a very long-term chart. Let's go to a weekly here. And you can see how it's been trending up. So that's in alignment with an improving economy. So while, prior to the last year or two where we heard about things improving, it wasn't shown on the chart, whereas interest rates weren't going up and oil wasn't rallying until, the last year and a half. So the intermarket analysis part that would, we were being fed by the media of things improving, we look at the charts and it's like, really, where is it?
I was just going to say, it's another example of the media versus it is what it is. The charts don't lie.
Right. So, oil doesn't look exactly like the crude oil chart, but you can see this bottom here and just look at the monthly it's in a nice little uptrend here, and it's got room to move higher after that big drop that it had. So oil looks like it's going to go higher. Yeah, and I have to rub a little salt in both of our wounds here in this lithium ETF that we got stopped on. And why did it even look at it was, well, look at the monthly chart and the weekly chart. And after spiking down here, it just had this incredible run up. But it's okay, if you see something like this, because when you look at the long-term chart, it says it's just getting started. So we'll get this thing on a pullback, and it looks like it's got some nice potential.
Perfect.
So it's made this big explosive move on relatively heavy volume, but now the volume, got a bit climactic there. So that's one that we're going to be looking for to get on board on a pullback. And
so that's another commodity economy related positive.
Right. And batteries, electric cars.
Well, and electronics. Sure.
Yeah. Right. Now, wood was doing great, low interest rates and home builders and such. And now it looks like, that party's over, which kind of leads to, that KBH that you had mentioned, Dan, gapped up on good earnings and came back in again. So, if wood is rolling over and long-term interest rates are going up, that's not a good scenario for home builders. Just knowing that as well, if you see a chart that maybe you're considering it as a buy, realize that this intermarket analysis doesn't suggest that it's going to do well.
Yeah. Well, look at the IT Bravo rather.
Yeah. But that had a nice run, just like wood.
Yep.
And now it's correcting, and this little base that was going on here, now it's breaking lower. So what I love about this platform, guys, and I'll say this again because I'm not trying to sell it, I have no affiliation with them, but if everyone created a product like this, they'd have a phenomenal business. There's one of the fantastic things about this product, and on another page, I just click this. Well, I can bring it up here, but I can just click on this, and there are all the stocks within that ETF, which just made my work so easy to now, be able to do that. Well, I could link a minder to this minder and look at it, but I just clicked on that little button right there, and it opened those up, and I'll just sort it by volume, and look what's at the top. KBH. With a big nasty red day there. And
right. So the fundamental traders, not to change the subject, blow out earnings. They bought the dead high of that today.
Yeah. No, they weren't looking at the price of wood, obviously.
Yeah.
I mean, I see the size of this move, Dan, and I just know from experience that I believe there's no money in a bear call spread, but it would be a no-brainer if there was.
Yeah, absolutely none. Yep.
Yeah.
Unless you went out 3 months.
Yeah. Saeed, I'm sorry if I'm butchering your name, but this is TC2000. You can't do this in TradeStation unless you probably created it, all of this manually, which would be so labor intensive that it's ridiculous. This platform does not have the most beautiful charts. Not that TradeStation does; they're ugly actually, but in my opinion. Yeah. But the pluses for this platform is to If you want to do a top-down approach, which is what we do, broader markets, sectors, stocks within the sectors, into market analysis, there's nothing better than this platform. You have to put some of the pieces together, of course, but the work, the pre-work that it does for you is just phenomenal. And I used to do this stuff before, this platform had it all, where you'd go to a site and look at all the stocks within a sector and you type them all into a minder and do all that. Anyway, a lot of work. And so again, just being able to flip through the sector, and here's Lowe's, which isn't a builder, but it's when it's supplying products and stuff. So a little more diversified than that, but that's doing actually quite well. So we can go through these, look at a particular sector. Another sector that we could look at here, or commodity, copper, this is the theme, that things as the economy picks up, copper should do well, and that's starting to perk up here. Steel, which hasn't been doing great lately, and agriculturals, which that's been doing just fine. What else, Dan?
XLF, because of the Fed coming.
Yeah, that's been a weird move, and this was last week as it finally perked up off of the support area. And it's really the theme of this market is that, it starts to move up and then it comes back in, and then buyers step up again like it's going to the moon, and then they step away. And that's uncertainty. That's a picture of uncertainty. So financials, and when you see a picture of uncertainty like this on the daily chart, what you do is you compress it and you go to a higher time frame and you look for that to produce some clarity about what you're seeing. And you see it does do that. Whereas the monthly here has been moving up and pulling back and is trying to get going. And now last week's move, we've got a couple of days to go here and kind of produce a miracle move to reverse that. But so far, that's negating that nice breakout bar that occurred last week. Yeah. That's telling us that the NASDAQ's going up while we're talking here. Yeah, it's pushing up to the top of the range there. So there's the hourly chart. So while it's moved up, now is not the time to be jumping on board at the top of the range, especially in front of the news that's coming in a couple of hours. We'll see what happens.
Yeah, 1 hour. Yeah.
Yeah, exactly. I'm losing track of time here while we're having all this fun, Dan. Anyway.
All right. Well, I think, and in terms of tomorrow, I don't have any specific sectors to go to see how they're going to be affected. It's more everything we've been talking about, just overall, the index ETFs, market internals, volatility. But today will just be another one. And tomorrow should be very interesting too. And we're still in our caution mode until we get clarity. Well, why don't we conclude? It looks like we have 1 minute left. Why don't you look at the broader market ETFs and conclude with what clarity might look like?
Sure. Well, as I said, as we look at multiple time frames, it brings clarity. And if you're in a shorter one and things are erratic, you just keep going to a higher time frame until there's clarity. You attain a bias as to what you believe will happen based on a trend in support and resistance. So, for example, the Russell here, it's in a weekly uptrend and it's pulling back, which should produce a buy setup. And so now we're getting a whippy, erratic buy setup here. Look at the bottoming tail bars. So today isn't over, but based on the weekly and the monthly, and it's pulling back to support, this is how we determine where buyers should show up. And then we look for candlestick patterns that produce pictures that say they're taking control. And so you got this slop to deal with,
right?
But they're beginning to step up here.
Right, but that's what I was going to say though, and that's what's kept us sidelined. here's support, here's resistance, here's trading range, here's what's happening in the moment, but there's no pattern, like you said, picture of money for us to trade these. So that's why we're not.
Right. Yeah. Diamonds, which led the way up, stabilizing here today. That's a new all-time high, coming into the gap fill right there. So this is where, I started telling subscribers of our advisory letter, look for this to make new all-time highs, the Dow to make new all-time highs. And at the time, it was lagging everything. But the pattern was saying it was going to do it, and eventually it did. The transports, stabilization day today, right at support, but we've got this rounding kind of a top. So as we look at things, the broader markets here, none of them say that some explosive move is coming. The patterns like this typically don't result in an explosive move. So the expectation is probably more erratic kind of movement as the markets digest the gains and all of this news that's coming out pretty soon. Not that there's talk about it, but you're getting toward these elections in November, so that'll become a concern. The market's always going to have something to be concerned about.
Exactly.
The way it is.
Right.
We'll just continue to follow the trends as to the direction that they're going, and support and resistance and patterns and such. So we don't talk about this much. It pretty much moves like the Russell, but then you've got the mid-cap stocks. So all of this messy kind of price action, you look at these charts on the right there, and you see exactly what I'm talking about as far as clarity. They're going up. They're pulling back. They suggest they're going to continue to go up. This whippy price action is just that. It's just whipping around, and you move to the time frame that you choose to trade it in. Now, as intraday traders, you can find opportunity virtually on any given day. Some are going to be easier than others. As swing traders, we decide what it is that we're going to trade. So the markets aren't it right now, but there are stocks and uptrends that are doing well that pull back and they go higher, and they're like, who cares about the market? And that's what we search out day to day to find out what companies don't care about the market. And other times we trade the market. So with that being said, Dan, I'm kind of hungry.
All right. Yeah, that's a perfect ending here. So another great show. Thanks for attending, everybody. We'll tune in. We'll go back to the Master Trader Green trading room, of course, and we'll get set for our 2 p.m. FOMC announcement. Tomorrow, of course, we'll update daily as we do.
Hey, Dan, I think you sent me an email saying we're going to be doing a little marijuana next week.
Yeah, I think, and Pat even mentioned it earlier about, hey, marijuana stocks. Yeah, we're thinking next week's show, let's talk about how to trade marijuana stocks and options. Absolutely.
All right, everybody.
All
Thanks
right,
for joining us, and we'll be talking next week. All right, bye-bye.